Welcome to Finance Flashcards. In this video, we will look at what are the keywords that are in mutual funds, or whenever you open a mutual fund scheme or a dashboard, you see these words flashing onto you. But sometimes you do not understand what actually they mean. So in this video, we will try to understand all those important words so that whenever you see them next time, you will make a better investment decision. So let's get started with the video. Our very first word is NAV, net asset value. The very first thing you see when you open a mutual fund is net asset value. Now, what is net asset value? Its definition says that it is per unit price of a mutual fund, representing the market value of its assets minus liabilities. In very basic term, let's say NAV is equal to a stock price. Whenever we open a stock, we look at its price. In the same way, whenever we open a mutual fund, we see its NAV, net asset value. Now, what is the formula for net asset value? It is total assets minus total liabilities divided by total outstanding shares. For example, if a mutual fund has 100 crore in assets and 5 crore in liabilities with 10 crore unit outstanding, what will be the NAV? It will be 100 minus 5 divided by 10, which is 9.5 rupees per unit. Now, what is the significance of NAV? NAV changes daily based on fund performance. NAV gives me an idea of how the fund is performing. Let's say if the price of fund is rupees 10 as of today, and after a month it goes to 11, which means that in a month I am getting a return of 10%. So by the use of NAV, we can see how the fund is performing. Now, our second word is asset under management, AUM. And the definition of AUM is total market value of all investment managed by the fund. Suppose if a mutual fund has 500 crore invested across different mutual funds, stocks or bond, its AUM will be 500 crore. Now, what is the significance of AUM? A larger AUM will indicate investor trust and stability. And if AUM changes daily as investors buy and sell unit, asset price fluctuate. So you have to look for AUM relatively large so that it can be trusted and it shows that it has a stability. Our third word is expense ratio. Now, what does expense ratio mean? It says that the percentage of total asset a fund charges annually for management, administration and operational expenses. Let's say there is a mutual fund which has 1000 crore of AUM and it has an annual expense of 15 crore. So the expense ratio is nothing but 15 divided by 1000 into percentage term, which will be 1.5%. Now, what is the significance? Lower expense ratio mean higher take home return for investor. So what we have to look for those funds which has expense ratio as low as possible so that your return can be maximized. Now, our next word is growth versus dividend option. Now, these are different scheme that a mutual fund have. Some mutual fund scheme has growth scheme, some has different dividend options. Now let's look at what are they and how you can distinguish between them. So a growth option mutual fund are those mutual fund whose profits are reinvested and which increases the NAV of the particular scheme. Let's say there is a mutual fund which has 5 stocks and each stocks deliver a profit of, let's say, 10 rupees per share, and the company announced that the company will pay 1 rupees as dividend per share. So in growth fund, your 1 rupees will be reinvested into the mutual fund so that its NAV will increase, so does your return. But when you look at dividend options mutual fund, the fund manager will pay you the dividend separately, which means this 1 rupees will not be reinvested but will be delivered to you directly. And here in the example we can see the same thing. In growth option, the dividend will get reinvested, but in dividend option the part of the profit is paid to investor. Now, which one is better for you? Growth is better for long term compounding, because when you keep reinvesting your dividend starts to grow at the pace of the mutual fund rate. But when we need regular income in the form of dividend option mutual fund is suitable for you. Now our next word is direct versus regular plan. Now direct plan are those plan that are brought directly from the fund house, and regular plan are those plan that are brought through a distributor. Now what is the benefit of having a direct plan is that they have low expense ratio. Since they are brought directly from the fund house, they have less commissions and higher cost. In the example, we can see that a direct plan might have an expense ratio of 1%, while a regular plan can have 1.5%. Now, in short run, these 0.5% difference is not significant, but in long run, like a 20-year, these smaller percentage can have a very significant impact on your result. Moving on to our next word, which is SIP. SIP is one of the most heard term in mutual fund. Now SIP stands for systematic investment plan, and its definition says that it is a disciplined investment method where you invest a fixed amount at a regular interval. Now that interval could be monthly, quarterly, even daily. Now what is the significance of having SIP? The very first thing is it reduces your market timing risk. You do not have to worry about timing your market. You just have to put your money in the systematic investment plan, and it will keep on averaging out your portfolio. And the second thing is it encourages long term investing. Since you have set up a SIP for on a monthly basis or quarterly basis, you have to pay those SIP and your fund will keep on growing. So it encourages you for long term investing. Our next word is NFO. NFO stands for new fund offers. Whenever a new mutual fund come into the market, it is called NFO. It is very similar to IPO, which is initial public offering. So its definition is a period when a mutual fund scheme is launched for the very first time. For example, an AMC launches a new fund with initial unit price of rupees 10. What is the significance of NFO? It's allow early investment in new strategies. So whenever a new fund is available in the market, you see that okay, this mutual fund is based on particular strategy or a particular sector. You go there and you invest in that fund at very beginning. Our next word is exit load. Now what is exit load? According to its definition, it is a fee charged when an investor redeem or sell his mutual fund unit before a specific period. For example, if a fund has 1% exit load on redemption within 1 year and you redeem 1 lakh after 6 months, you have to pay 1000 as an exit load. So what does it tells you? It encourages you for long term investing and prevent frequent withdrawal. So what we have to look for, if you are investing for shorter time period, and if you are comparing two mutual fund A and B, and one has expense ratio of 5% and one has expense ratio of 1% only, then for shorter spam, scheme B would be beneficial for you. But if you are going for long term investment for like greater than 1 year, then you do not have to worry about which fund has more exit load or less exit load, because you are going for more than 1 year. So our next word is load fund versus no load fund, and it is also an extension of, you can say, exit fee. Just like exit fee, we also have entry fee, and with fund that has low load fund, they charges fee on buying and selling, and no load fund does not charges anything. For example, if you invested 50,000 into a load fund which has 2% entry fee, then only 49,000 will be actually invested. So what we have to do, While investing in mutual fund scheme, we have to check what are their exit fee, what are their entry fee, and we also have to look for the time criteria. Like if you want to withdraw within 1 year, then we have to look for what are the exit fee are there. If the exit fee is very high, then we have to avoid those mutual fund. Moving on to next word, which is open ended versus closed ended fund. Now what are open ended fund? Open ended fund are those scheme that where you can buy and sell unit anytime. But in close ended fund, you can buy those mutual fund when they are new and they are giving the new offering, and they can only be redeemed at maturity. Most of the mutual fund are open ended, but if you come across mutual fund that are very close ended, so you know that you cannot buy them after offering, so you have to buy them when they are offering for the first time. And then the more important point is you can only redeem them at their maturity. So if a scheme has 5 year of maturity, you can only sell those mutual fund after 5 year. For example, it could be any mutual fund. These are for only example, these are not investment advice. So look for those scheme very carefully, what they actually tells you. Our next word is Sharpe ratio. Now these are the few ratios that I'm going to talk about next. And Sharpe ratio is something that you will not find on the front page of any portfolio scheme, but you have to go to analytics of the mutual fund to know the Sharpe ratio. Now what does Sharpe ratio tells you? Sharpe ratio tells you it is the risk adjusted return. What is risk adjusted return? Let's say your portfolio delivers a return of 12% and the risk free rate in the market is 6%. I will talk about risk free rate in a separate video because it's very long topic. So and the market and the standard deviation of the fund is 4%. So your Sharpe ratio is 1.5. In shorter term, what we have to look for here is a higher Sharpe ratio, which means that it is delivering better result. In very simple term, this 1.5 mean that if you are taking 1% risk, then your fund is delivering 1.5% return. So obviously for 1% of risk, we need those scheme that delivers me higher return. Suppose there is another scheme which delivering me 2% return and has a Sharpe ratio of 2, which means that this scheme is better, delivering better return per unit of risk than the other scheme. And its significance, as I said, Sharpe ratio is equal to better risk adjusted return. The higher the number, the better the risk adjusted return. So our next word is beta. Now what is beta? Beta measures a fund sensitivity to market movement. Beta is a benchmark where we see that how that particular fund is volatile related to a broader market index. Suppose a fund scheme has a beta of 1.2, which means that the fund is 20% more volatile than the market. And if the beta is 0.8, which means that fund is less volatile than the market. What is the significance? High betas are for those investors that are willing to take more risk because you are dealing with more volatility. If a scheme has 20% more volatility than broader market index, which means higher volatility delivers higher return. If volatility increases, your return increases, but your risk also increases. And if the scheme has low beta, which means it is suitable for conservative investor who do not want to take much risk. But what is the consequences? Your return will also decrease, but it will be very stable. And our final word is fund of funds, FOF. Fund of fund is mutual funds that invest in other mutual fund instead of direct stock or bond. Let's say a portfolio manager made a scheme which invest in different mutual fund. Let's say ICICI Prudential Mutual Fund, SBI Mutual Fund, Kotak Mutual Fund. So the portfolio manager decided that rather than going for individual stock, I'm going to go for different mutual funds. Now what will happen after going for different mutual fund? It will provide me with more diversification, but it will comes with double expenses. Why? Because we will pay this portfolio manager expense also, but since this fund manager is already investing in another scheme, this fund manager will pay expenses here also, so we will pay double expenses. So what is the benefit? It provide diversification, but what is the downside of it is that we pay double expenses on it. So these were the few basic terms that you should be knowing before investing in mutual fund, and I hope you like this video. And if you like the video, do subscribe to the channel.